Welcome back. The market has made an amazing run so far in 2017. So if you invest in the stock market today, do you need to worry about a downturn? And how can you protect your principal? With us now to talk much more about that is Michael Canet, the savvy investor. Michael, welcome aboard.
Good morning.
It's great to have you here. And I think this is something maybe on people's minds who have some cash on the sideline. They want to get it into the market and get a return, but things have gone so high. How do you protect that principal? It's an interesting question.
And I think that's always the case, right? Everybody wants the upside without the downside, right? Well, you know, always buy low, sell high. That in theory, that should work all the time. I think some of the things you need to consider is that we are at an all-time high, and notwithstanding the volatility we've seen over the last couple of weeks, and some of the volatility that we expect to see with the tax cut coming into play, people do need to be concerned about that pullback. We've been talking about this for 4 or 5 years, a 20 to 40% pullback. And so what do? You know, some people understand the idea of dollar cost averaging, where if you have some money sitting on the sidelines, maybe it makes sense to put in, 10 to 20% of whatever that nest egg is, put a little bit into the stock market at a time.
It's like a monthly basis?
Right.
Okay.
So what you're doing is you're buying on the ups and downs. And in theory, what that does is it spreads out the risk of buying high every single time. Okay. So that's a concept. We've talked in the past about if you decide to plunk all your money in the stock market on a Tuesday because, you want to get the upside, but again, you don't want to risk the downside. There are some techniques involved. I think you need to be a little bit more of an astute investor. It's not for the faint of heart because you can get hurt. There are some things called stop losses. You and I have talked about those for your own portfolio in the past. And the idea here with the stop loss is you buy a position. Let's just say you buy XYZ stock. Mm-hmm. You can't do it with mutual funds, unfortunately, but with a stock or an exchange-traded fund, you can. Let's say you buy a stock at $100 a share. You can put an order in with Charles Schwab or Fidelity or TD Ameritrade, any of those guys, that says, look, I want to sell this stock no matter what happens. I want to sell it at a predetermined price. If the stock market goes from 100, if my share goes from 100 down to, let's say, 80, okay, you're willing to take that 20% drop.
20% drop.
That's your stomach level, how much I can, anxiety, right?
That's it, no more than that.
No more. You can put an order in at 80. And in theory, now that's the important part, in theory, it should sell if the market ever drops below 80. Unfortunately, that's not the way it always works, and that's where the scary part happens. What happens is that the market, you've seen those movies where those guys are screaming on the floor, buy, sell, sell. Yeah. That's really the way it goes. And unfortunately, they have to buy, which is important to us as we want to sell, but they don't have to buy at our price. Just because we say we want to sell it at 80 doesn't mean they have to buy it at 80.
If the market was really going down, it may not catch at 80. It may go through.
Right. So if you remember that flash crash that we had in August of 2015, the SEC, the people who kind of oversee the whole stock market, they actually closed the stock market over 1,000 times for 7 seconds at a time. Now think about this. If you actually thought about how many 7-second intervals there were in a day, what have you thought in an 8-hour day there were 1,000 of them?
I wouldn't have known.
So they closed it 1,000 times. And what that meant for people that had stop losses is that they put the order in at 80. The stock market closed, and I'm making this up, the stock market closed when the stock was at 81. Mm-hmm. And when it opened up again, the next offer price, which is what you want to sell, the next offer price was 50. So instead of selling at 80, you sold at 50 and you took a 50% loss.
Gotcha.
So it can be scary. Yeah.
But you can dollar cost in, you could potentially set a stop loss. And then I guess the last thought about it is, as you select investments, if you're concerned going in high, you could go more conservative. That's the other piece here.
Well, and there are some other things, right? So, not that an annuity is the right tool for everybody, or not that a preferred stock's the right tool for everybody, but if you're protecting your principal is the goal, you could buy a stock or a bond that pays a dividend or an interest rate or an annuity that pays an income, and just take that income and invest that in the stock market, preserving your principal, right? There's some software out there called Wealth Guard and Asset Guard. And what these two softwares do is they give you notices as you come closer and closer to that strike price, where I want to exit, where I'm nervous. They'll tell you ahead of time, hey, time to get out.
Wow. So much on this topic to get to. If you'd like to dig in more with Michael and his team, for the first 5 callers, portfolio $250K or greater, a full-blown retirement plan awaits you. Contact them now, 866-597-1040. Michael Canet, thanks so much for coming in. We may even have to dig in on this more next week. This is a great topic, protecting that principal. Thanks for being here.
Always a pleasure.
We'll be back with more Midday Maryland right after this.